A simple question to start with: can investors beat the market? To see that, we compare how investment funds performed over decades against the S&P 500. This chart shows how $1 grows over time. After 10 years, the S&P 500 is about twice the median fund. From 10 to 40 years, the gap changes but keeps widening. By the end, the S&P 500 is roughly 3 times higher. This doesn't mean funds are bad. It shows how difficult it is to stay ahead of the market. We start with the fund universe. In 1985, there were about 1,200 active funds. Each point here represents one of them. As years pass, new funds enter, old ones disappear, and the total grows quickly. By today, there are around 27,000 active funds. But growth in number doesn't mean longevity. Most funds close within 10 years. After 20, the count falls sharply. Few survive 20 years or more. This distribution shows how long they stayed active. This survival pattern creates a bias. When we look at today's funds, we see only those that made it so far. The ones that failed, often after weak performance, are gone from view. This is survivorship bias. To measure true fund performance, we include all funds, not just the survivors. Here, a few funds defy the odds. Some outperform the market for 40 years or more. But these are rare exceptions. So, it is not impossible to beat the market. A few funds have done it. But those cases are rare and the S&P 500 still outperforms the most. And why does a simple index, one that makes no decisions, win so often? The answer has less to do with the strategy and more to do with the time. To see why, we need to look at how returns behave across different horizons. Beating the market for a single year or even 5 is very different from beating it for 20. In short horizons, returns move almost at random. They rise and fall without pattern, driven by noise more than structure. Over long periods, short-term noise fades. As 20-year volatility levels out and returns stay mostly positive, the market benefits from stability and steady compounding. For investors, it is the opposite. A strategy can work for a while, but as conditions change or others adopt it, the advantage fades. Holding that edge over decades becomes difficult. We can summarize this behavior with a simple rule. Volatility shrinks as the time horizon grows. It gives us a clear way to describe how uncertainty changes through time. The rule is straightforward. Volatility over time equals short-term volatility divided by the square root of the horizon. When we average returns across longer periods, they naturally become more stable, even though the underlying randomness stays the same. Now, we can test this rule against real data. The blue line shows what history gives us. The green line shows what the formula predicts. They track each other closely, confirming the relationship between the time and volatility. To make this less abstract, we can look at the odds of losing money. Over short horizons, losses are common, roughly 1 case out of 5 within 5 years. At 10 years, they're rare, but 20, they almost disappear. At the 20-year view, returns stay positive even through recessions. Short-term declines come and go, but the long-term trend remains upward. Those steady returns add up. This curve shows what $1 investment made in 1984 has become. Growth began slowly, but then accelerates as gains compound on past gains. So far, we've seen that time reduces risk. Now, we can look at what drives the growth itself. Over long horizons, most of the total growth happens later. That's the nature of compounding. Here, we show a simple case. 30 years of fixed 8% yearly growth. This is close to the market's long-term average. There's no volatility in this case. only the exponential growth. Now we look at the same average return, but with variation. Instead of a flat 8% each year, the sequence alternates between 28 and -12. The average remains 8, but the path changes. After 20 years, the smooth case grows about to 4.7, while the volatile ones end near 3.3. Both share the same average return, yet the outcome is smaller when the volatility is present. This gap exists because the arithmetic and geometric growth are not the same. When returns are steady, both give the same result. When returns fluctuate, the geometric rate falls. Losses pull down the total more than gains lift it. More volatility means a wider gap over long term. When people talk about expected return, they usually mean the arithmetic average, what they hope to earn each year, but the real wealth grows at the geometric rate. Reducing the volatility raises that geometric rate. If two investments have the same geometric return, they end with the same amount of wealth. The pattern of gains and losses doesn't matter, only the compounding does. Arithmetic returns show the average from one period to the next. Geometric returns show how the entire investment grows over time. To make this idea precise, we use what is called the volatility drag term. It links the average return, the variance, and the long-term growth rate. Take an example. Assume the average annual return is 8% and volatility is 15. Applying the formula gives us a geometric rate near 7%. That 1 point difference compounds into roughly 15% less wealth after 20 years. As the time horizon expands, volatility falls, the drag shrinks, and the growth approaches pure compounding. Now, we can return to the main question. The goal for any investor is to grow wealth over time. Volatility and time shape how fast that growth happens. Let's look at the same data again with that in mind. Here we see the chart comparing the S&P 500 with the median fund. With our new understanding of the compounding and the volatility, the reason for the gap is clear. Over time, lower volatility lets the market compound more smoothly. The S&P 500 grows steadily and the gap gets wider. We have followed how volatility, time, and the compounding shape the long-term returns. FinanceLab.ai is built to study these relationships in real time. All of these examples and many others can be explored directly at FinanceLab.ai.